Chris Robinson joining us this morning, Managing Director of TJAM Institutional Services, to look at the inflation figures. Chris, talk to me. What stands out in this number for you?
Well, I think people were expecting. It looks like we got what we were expecting. Honestly, it's the Friday before Christmas. Initial reaction. That's not a very big range, in the S&P. So I would call it muted. Last month, I believe the durable goods were a lot worse than people had thought. That was one thing. So that's durable goods as a indication as to how much people will go out and buy, spend on big ticket items, long lasting items. And last month that was the big kind of a negative surprise. So to see it holding up here, I think is pretty good. As far as the PCE, the price index, that core, I think we were. Correct me if I'm wrong. You might have the figures in front of you.
It's at 0.1 for the core, Chris. They were looking for 0.2, and it looks like the prior got revised to 0.1, down from 0.2. So it does seem to be kind of feeding into those inflationary pressures, easing a little bit. Yeah. I'm looking at stocks selling off here a little. Maybe the focus is on that durable goods orders number, but core PCE at 0.1. I mean, that's pretty appeasing for the bulls in many ways. They were looking for 0.2.
Yeah, so there you go. It's a early Christmas present for Chairman Powell. Kind of stays with certainly what the market has thought in the past 2 months.
Yeah.
I also think that if you look at that, I mean, that's the big move. In the last 2 months, the S&P and the Dow both rallied 17%. You can't rally 5,000 points or 5,600 points, whatever it was, and 700 points in the S&P, and then you can't get so upset when you have a 1% move back. It's just, I don't understand. I mean, I've been doing this, as long as you, probably, maybe a little bit longer, but it really is the percentages, and you can't expect that you have a 17% move in 2 months and not have any pullback at all. Well, so I think that's something we're all going to have to get used to. And even right now, I mean, so the S&Ps right now, they're down 3 points. I'd call it a muted reaction. It's a holiday market. And I think that we probably going to have a choppy day until the end of the day, to the end of the close. That's what I would say. So, if you were worried about a really bad news number, I think everybody dodged a bullet. It looks like it was an early Christmas present for Chairman Powell.
It sure does seem to be. Let's pull this chart back up here again, because I think it sort of provides the visual, a couple points that Chris is just making there in terms of the strength we've seen throughout the month of November and December. Yes. The move lower that we had earlier this week, but you can see how, in terms of the bigger picture, it's just a blip on the radar right now. Yeah. Also here, in terms of this number, and it kind of feeds into something we were talking about a little bit earlier on the show, Chris, this is a backward-looking number, right, in terms of that inflation activity that we've seen over the last few months here, but we're still seeing consumer strength. We're still seeing strong labor conditions here in the U.S. So maybe as that consumer strength is where the focal point here being, as the indices come off, that durable goods order number, again, that indication, bigger ticket items, that direct look into the health or well-being of the U.S. economy, maybe that's where the focus is, because there are some concerns that the Fed hasn't completely weeded out inflation at this point. And if it does kind of crop its way back up, ultimately, then we've heard about how it's going to be more difficult to work to get it out of the economy. And we've also talked a lot about how getting from 3 to 2 is really where that hard work comes into play.
Absolutely. And there's been a lot of discussion. Is this 1970 where the Fed eased too soon and then they got a backdraft? Like, I remember that old movie where all of a sudden you get this oxygen into the room and the house really catches back on fire. That's the next thing. We've gone from, is it a pivot to, is this a trap? So there you go. It's probably going to be the next thing we worry about for the next 6 months, but certainly just the tremendous amount of outflows. And if you look at the sentiment, if you look at some of the numbers out yesterday, the level of money managers that were short in October, now they've all flipped and gotten long. So that, to me, if you're a day trader or long-term investor, it's kind of like watching a party where everybody's poured back in. The police are gone. The punch bowl's back. I would be concerned about that, and we'll have to see. But again, I can't stress that enough. The one thing I wanted to say this morning: you cannot get so excited when we have 1 or 2% moves. With the Dow Jones at 38,000, okay, 1% is 300 points, 380 points. we are going to have, and you and I, again, for years in the business, anything less than 5% was considered noise. A 5% move in the Dow is now 1,900 points. We're going to have some 1,900 point days, some 1,900 point weeks. And say, just get ready for it. It's the price for being at these levels. Percentage moves become bigger. And I would just caution people that more than ever, especially if you're trading futures, you better have your discipline. I don't care if you're a bull or a bear, because we are going to have big moves.
And we've seen that, right, into the end of the
Yes.
year. And it sounds like you expect that to continue. And
Yes.
again,
Yes.
to the point, definitely difficult to fade this move on the way up throughout November into the beginning of December. But sustainability does become an issue once you see gains to
Yes.
this extent and to the magnitude that we've had. Just diving a little bit deeper into this number and kind of feeding into your point a minute ago, personal income month over month at 0.4, up from 0.2. If we see that play out over the next 6 months, then that would be a bit of a concern for the bulls
Yes.
as well. That's not necessarily headed in the direction the Fed wants it to. That's kind of an outlier as I look at this number here right now. Chris, talk to me, because Kaplan said that, well, we need to see 3 months of contained, sustained improvement before the Fed does something, kind of talking again along the lines of expectations as far as cutting rates. But this number sort of feeds right into that, right? I mean, we're seeing sustained progress here, maybe not to our goal yet, but still sustained progress.
Absolutely. And I think as long as they continue to say that they are data dependent, which we've heard a lot of that.
We'll have to be as traders.
Yeah, we just got to be. And the good thing is, every time we have one of these numbers, it's opportunity. Opportunity is movement. Bull or bear, if you are looking for an opportunity, it's going to be there. So we're going to have lots of volatility. We're going to see volatility in the bond market that we have not seen really since the late early 90s, when we had those big swings. And as the market reprices the risk, and the risk is the Fed done or is the Fed not done? The risk is, did they back off too soon? People love, that's like generals fighting the last war. Everybody goes back to 1970. It's going to happen again. It's going, well, you tell you what, there's going to be a lot of opportunity there. And the good thing is we're ending the year. Most people like bull markets. We're ending the year with stocks at all-time highs.
Yeah.
And it looks like that's going to hold through the end of the year. Now, January, February, March, the first quarter, it's going to be a whole new ball game.
Chris, we're going to have you back here to take a look at price into the new year. Hopefully,
yes.
You will join us. And we do want to thank you, and we do appreciate your contribution throughout the year. So always a pleasure to have you on the show. Chris Robinson joining us this morning from TJM Institutional Services.